Have you ever wondered what happens when the world's financial system just breaks? When the numbers on the screen stop being abstract and start affecting real lives, real families, real futures? Today, we're not just talking about a dip in the market. We're diving deep into the 2008 global financial crisis, a market crash that didn't just rattle Wall Street. It sent shockwaves across the entire globe and fundamentally changed the world we live in. This isn't just a history lesson. It's a story about human ambition, systemic failure, and the enduring consequences that you and I are still dealing with today. So, how did it all begin? It starts with a simple, powerful idea, the American dream, owning a home. For decades, this was a cornerstone of stability and prosperity. In the early 2000s, this dream was supercharged. Interest rates were historically low, making it cheaper than ever to borrow money. Banks and lenders eager to profit started handing out mortgage like candy at a parade, and they got creative. They invented something called the subprime mortgage. What's that? Well, a prime borrower is someone with a good credit score and a stable income, a safe bet. A subprime borrower? Not so much. These were loans given to people with poor credit history or low income, people who would have normally been turned down. Lenders weren't too worried, though. Why? Because house prices were going up and up and up. It seemed like a sure thing. If a borrower couldn't pay, the bank could just foreclose and sell the house for an even higher price. On paper, it looked like a win-win. Everyone was making money. But here's where the story takes a dark and complex turn. The banks didn't just hold on to these risky mortgages. That would be too simple and too risky for them alone. Instead, they packaged thousands of these loans, good ones, bad ones, and really, really ugly ones, into complex financial products called mortgage-backed securities, or MBS. Then they took it a step further, chopping up these MBS and repackaging them into even more complicated instruments called collateralized debt obligations, or CDOs. Think of it like a fruit salad. You have some good fruit, the prime mortgage, you have some okay fruit, and then you have some bruised, borderline rotten fruit, the subprime mortgages. Wall Street's financial wizards mixed it all together and sold this giant fruit salad to investors all over the world. Pension funds, other banks, even entire countries. They told everyone it was a delicious, safe investment. How? They went to credit rating agencies, the supposed independent referees of the financial world, who gave these toxic bundles their highest ratings, the same rating as the most secure government bonds. It was like stamping grade A organic on a bucket of rotten fruit. This created a gigantic, invisible bubble of risk, and almost no one understood how fragile it all was. For a few years, the party raged on. Wall Street traders got massive bonuses, construction boomed, and it seemed like the prosperity would never end. But then the music started to slow down. The low introductory teaser interest rates on all those subprime mortgages began to reset to much higher rates. Suddenly, millions of homeowners saw their monthly payments skyrocket. People who were barely making ends meet were now completely overwhelmed. The defaults began. First a trickle, then a stream, then an unstoppable flood. Remember the assumption that house prices would always go up? It was wrong. As more and more foreclosed homes hit the market, supply overwhelmed demand. House prices didn't just level off. They plummeted. The foundation of the entire system, the ever-increasing value of American homes, crumbled. That fruit salad of mortgages? The rotten fruit was now contaminating everything. The value of those MBS and CDOs, once considered as safe as gold, evaporated overnight. And this is where the panic truly set in. Banks and financial institutions all over the world suddenly realized they were holding trillions of dollars worth of assets that were now effectively worthless. They had no idea who was holding the bad debt or how much of it there was. The trust that lubricates the entire global financial system vanished. Banks stopped lending to each other. Credit froze. It was like the world's economic circulatory system had a massive heart attack. The dominoes began to fall, fast and hard. In March 2008, the investment bank Bear Stearns, a Wall Street giant for 85 years, collapsed and was sold for pennies on the dollar. The government stepped in to nationalize Fannie Mae and Freddie Mac, two mortgage giants that backed a huge portion of the U.S. housing market to prevent total catastrophe. But the real Lehman moment, the one that history will never forget, came in September. Lehman Brothers, the fourth largest investment bank in the United States, a 158-year-old institution, was hemorrhaging money. After a weekend of frantic, failed negotiations to find a buyer, the U.S. government made a fateful decision. They let it fail. On September 15, 2008, Lehman Brothers filed for bankruptcy. The shock was immediate and global. It was the signal that no one was too big to fail, or so it seemed. The very next day, the government had to bail out AIG, the world's largest insurance company, with an $85 billion loan because its collapse would have taken the entire global economy down with it. The fallout was catastrophic. The stock market went into a freefall, wiping out trillions of dollars in wealth. Retirement savings, college funds, personal investments, gone. The credit crunch starved businesses, big and small, of the capital they needed to operate. This wasn't just a Wall Street problem anymore. It was a Main Street crisis. Layoffs swept the nation and then the world. The unemployment rate soared. People lost their jobs, their homes, and their hope. The Great Recession had begun, so what changed forever? First, the relationship between governments and the financial system. The era of light-touch regulation was over. Governments around the world passed sweeping new laws like the Dodd-Frank Act in the U.S., designed to increase transparency, reduce excessive risk-taking, and prevent another meltdown. The concept of too big to fail became a central and controversial part of public debate. Second, it changed the global economic landscape. The crisis accelerated a shift in economic power from the West to the East, as countries like China, with their massive reserves, were better insulated from the initial shock and played a key role in the global recovery. But perhaps the most profound change was cultural. The crisis shattered the public's trust in financial institutions, in governments, and in the experts who were supposed to be watching over the system. It fueled a deep sense of anger and inequality, a feeling that the people who caused the crisis were bailed out while ordinary citizens paid the price. This sentiment has had lasting political consequences, contributing to protest movements and a rise in populism around the world that we still see today. It also exposed the deep-seated fragility of our interconnected world, showing how a problem in one corner of the market could ignite a global firestorm. The 2008 financial crisis serves as a stark reminder that in our complex world, risk can hide in plain sight, and the pursuit of short-term profit can have devastating, long-term consequences for us all. It's a story that's still being written in our economies, our politics, and our lives. Thank you so much for joining me on this deep dive. If you found this breakdown insightful, please hit that like button and subscribe to the channel for more stories that explain the world we live in. Drop a comment below with your thoughts or memories of that time. Stay curious, and I'll see you in the next video.